All right. So we are here for the last talk of the day. So it's pretty excellent. So I'd like to introduce Daniel Nadler, who is the co-founder and CEO of Kensho Technologies, which is a Goldman Sachs and Google venture-backed technology company. He also is Director of Research for Financial Technologies at Stanford University School of Engineering, did his PhD studies at Harvard University, has served as a visiting scholar at the United States Federal Reserve. He is an author of the book, The Global Debt Crisis, and in his free time, he's an editor at the Digital Edge, the Institutional Investors Technology column. So, welcome.
Thank you. Yeah. Thank you for having me.
Great. So I was hoping you could start by just telling us a little bit about Kensho and what you do.
Sure. Let's make sure the mic works. Yeah, thank you for having me at this conference. Very interesting stuff. So, Kensho is the largest provider of analytics to the global banking system. We power the majority of the global banking system's risk analytics. We're backed by Goldman Sachs, who's the largest outside shareholder in the company. And we have two broad divisions, two broad lines of business. One is risk analytics and helping large banks and financial institutions understand non-traditional sources of risk, so things that are not reducible to a PE ratio changing, but which include geopolitical risk, which include weather phenomena, which include new developments and product releases and technology shifts. And so what we do is we take all of that data, which has historically been very difficult to structure and analyze, and structure that data and analyze that data with respect to the positions that banks have, with respect to the positions that they're interested in taking. And we help the financial system, for lack of a better term, form a more holistic picture of their risk and exposure within the global environment. The other big part of what we do is we power about 80% of the global televised business media analytics. So if you ever watched CNBC, the Kensho stats box and the stock ticker, that the analytics part of the stock ticker. So we build the engine that powers most of the televised business media analytics. So they're two very different kind of business divisions. Mm-hmm. One is sort of helping the banks, and the other is television. So Kensho's become a hybrid between a media company on the one hand and a very large institutional banking system risk company.
Mm-hmm. So could you talk a little bit about how Kensho started and where the idea came from?
Sure. So as you mentioned, I was finishing up my PhD at Harvard, and I had obtained an academic appointment at the U.S. Federal Reserve, and we were in the midst of the financial crisis. This was during QE2, and it struck me when I was there how, as things were happening in the world, for example, a central bank in Japan would lower interest rates, a central bank in Europe would make a statement about unconventional monetary policy, but also there would be later on the Arab Spring. As these things developed in the world, even the Federal Reserve, which was entrusted with the safety and safekeeping of the financial system, at least from where I sat as a scholar there helping the Fed try to understand volatility in markets, there weren't really tools, there wasn't technology that you could use to sort of piece together all this heterogeneous data. So what the Fed was really good at doing at the time, still is looking at employment data, looking at inflation data, and saying, okay, based on these trends, we can do this linear extrapolation here, and the economy we anticipate will be here if these trends continue. What we couldn't do at the time was say, okay, when the European Central Bank lowers interest rates and there is geopolitical disturbance in the Middle East and there's a third condition, what is going to be the impact to macro assets? We just didn't have the tools to do that. So it really started from that experience, and I said, well, if it seems like an interesting opportunity that I'm in this, if they're the most non-resource constrained environment in the world, right? Because they print money. So anything, it's true. If you work at a bank or if you work in these financial institutions, there usually are some budgets in place to buying technology. When I was at the Fed, if I wanted, two Bloomberg terminals, a Thomson Reuters terminal, a FactSet terminal, a Cap IQ terminal on my desk, even though there wouldn't be desk space, no one would even ask. Like, I could just buy anything that existed in the market. And there was nothing to buy. That was my insight. There was nothing I could actually, I had an unlimited budget, and there was just nothing I could buy to help answer these questions based on what I realized to be non-traditional data sources, political data, weather phenomena data, and other types of data, essentially event-driven data. So I said, well, okay, this is odd that there isn't really anything to buy. And I assumed, naturally as people do, that if there is an oversight in some part of the market, Google must have figured it out, right? So I went to the West Coast, and I basically got a meeting with Google, and I said, look, I'm a scholar at the Fed. I'm not an entrepreneur. I'm an academic by background. But it seems very odd that I'm in this air traffic control of information, and there's nothing that's organizing and structuring all of the disparate things that drive financial markets. And you guys, this is what you spent all of your time thinking about and focusing on. And your mission is to organize all the world's information, so why isn't this organized? And their answer was basically because, Wall Street doesn't exactly have the best reputation these days, and finance at Google is kind of like the F word, and that was really their answer. When I said, okay, well, that's interesting, because that's really an arbitrage, right? Where if you guys, who are going to be the people who figure everything out, don't want to do it, and the financial system can't, then that is an interesting arbitrage there. So I said, okay, well, you're not going to do it, but what do you think about, backing an effort to do this? And they had never made an investment in an enterprise financial technology company before. So Google is interested in consumer-facing, stock trading apps and retail-facing things, and credit and so on. But they were intentionally and consciously avoiding anything that had the color of Wall Street to it, and they had never done something like that. So it took, I would say, a couple months of just persistence. I was just very persistent with them, and I eventually persuaded Google to essentially back an effort that had the following construct. Your mission is to organize all the world's information. The largest swath of information in the world that remains unstructured and unorganized is financial data, but more importantly, the data that is peripheral to financial data, geopolitical, weather phenomena, product releases, these types of essentially event-driven things that affect financial data. We're going to go in and structure it and organize it, and you're going to help us, and you're going to give us engineers to do it. It sounds like a big ask, but it is, and it was. But they agreed, and I think their thinking had come around by that time to, on the scales of we don't want to touch anything that has the color of Wall Street versus we really want to fulfill our mission to organize all the world's information, and this is truly a deeply unorganized piece of it. The scales tip to that other side. So the company Kensho started as a spin-out of Google was our first institutional backer. It started as a spin-out of a bunch of Google engineers who they actually helped us recruit to do this, and it was great. It was crazy. They said, look, we have these people who wanted to work on Google Finance, which, as everybody here probably knows, hasn't been updated since 2006, and it was never a priority or an agenda internally to go do that. So we kept them on search, or we kept them on AdWords, we kept them on. So they sort of initially kind of lent these people to us, and eventually supported us sort of spinning out a team from Google to go do this. And so we really started as a bunch of Google engineers and myself with my sort of academic Fed Reserve background. And we started building on that mission, which was, can we take all this information in the world and in a very Google-like way structure it? And as we began to do that, the banking system became very interested, and we got sort of bids from the various banks to become kind of the lead investor, lead backer in this effort. We chose to work with Goldman Sachs, and so Goldman Sachs has since become our lead backer, and that's what we do now in our mainline business. The media stuff is fun, and powering kind of television is kind of fun, and the reason why we do that is we wanted to fulfill on that initial premise of we can really democratize this information. So we didn't want to be this kind of very shadowy. We didn't want to just be this kind of very shadowy company that Goldman Sachs backs that works invisibly on the back end of the financials. We wanted to have a very public face as well, and that's the decision on the media stuff. So that's kind of how it started.
Great.
Can I give you this?
Oh, sure.
It shouldn't have any setup.
Oh, okay. Hello? Yep. Oh, great. Okay. So you recently said that there's a tipping point coming in finance where we've had those who are early adopters of tech became expensive gatekeepers. I wanted to get your perspective on how do we change this or remove them?
Yeah, so what's interesting about finance, especially when I say finance, I mean institutional finance, not retail, is you have had, let's call it 1990s Microsoft style monopolies in financial technology for much longer than Microsoft was able to maintain its monopoly. So you've had a handful of firms, one of which famously is Mike Bloomberg's, who's become one of the wealthiest people in the world with that monopoly, that were, simply speaking, the first to introduce computer systems. I mean, their accomplishment should not be diminished in any way. They were the first to introduce computer systems into banks, Mike Bloomberg specifically. And so that he's started a $40 billion company is nothing to condescend toward. But what's interesting about the financial technology space and what I was alluding to there was, any other occasion where you have the largest industry in the world and one or two monopolistic or duopolistic incumbents that have for 40 years maintained that monopoly, every Sequoia, Excel, Kleiner Perkins, Andreessen Horowitz is going to be pointing to that and saying there is no juicier fruit on the tree that is ripe to be disrupted. And that was true of all these other industries that truly did get disrupted, like, for example, the taxi services by Uber. The difference, the critical difference that people fail to appreciate with institutional finance is how deeply regulated that space is. So it is not at all inviting for all these little disruptive tech companies to come and eat up the largest market in the world, which would be the VC fantasy, right? So you asked about the founding of Kensho. A lot of the founding of Kensho involves spending hundreds of hours at minimum reading the Volcker Rule, right? Reading financial regulations, this is quite literally the most regulated space on the planet. And in many respects, it's anathema to the way engineers think. Most engineers are like, all right, well, this is not really rational or logical the way this thing is constructed. So what if I just move this piece here and move this thing here, and then it'll be more efficient, right? And that works in the consumer-facing world. In institutional finance, you can't move this piece here and this piece here, and it's rational because there's a regulation or a law preventing you from structuring data that way, right? So if you're working with a bank's data and that bank is viewed as a linchpin in the global financial system, there's certain ways that you have to silo and segment the data, and none of these ways correspond to what the rational or most efficient way to do it is. So that has been the major friction point that has allowed firms like Bloomberg to maintain these monopolies, because Bloomberg has spent the last 40 years thinking about nothing other than these regulations and how it impacts their technology development. I think what's going to change is not the regulations. The regulations are becoming more stringent. We're seeing more of them. What's going to change, I think, is the model of tech companies that succeed. And what I mean by that is, historically, the Silicon Valley model encouraged entrepreneurs to say, all right, think about the widest scale, the broadest scale possible business, identify your early adopter silo, prove out the use case, get early adoption of that use case, and then scale, right, broadly across verticals. Which is why you saw historically companies that said, well, we're a machine learning company. We're not a Wall Street company, we're a machine learning company. And they viewed healthcare or energy or finance as just like a use case, like a proof of concept. And they would go into one of these domains and prove out whatever their engine was, a machine learning engine or some analytics engine. And the strategy, and the problem is that this was encouraged by the VCs. The Andreessen Horowitz of the world clapping, just go do this. And of course, they would get to finance and the banks would just laugh, right? There's just a massive graveyard of companies in this model that attempted to knock on the doors of Goldman Sachs, and they just got laughed out the door, because Goldman's view is like, let me understand this. You built out a machine learning engine in healthcare to help doctors understand patient data better, and you've spent the last 3 months doing it, and you've gotten some great feedback from some doctors, and now you want to structure credit default swap data. But this is literally what has happened in the industry as a result of the encouragement of these VCs. And I think that model was roundly falsified and invalidated by the lack of market traction that companies that pursued it got. And I think you're seeing a new generation of much more focused businesses, right? It's blending the tech idea of scale with the old world, old-fashioned brick and mortar idea of actually build a business, actually obtain domain knowledge in a space. And that's been our ethos that I think has been a critical piece of our success, because you can imagine over the course of our technology being on television and like literally 200 million people seeing it every day, that we get inbound from Coca-Cola or Procter & Gamble or healthcare companies saying, hey, can you apply whatever this StatsBox thing is to our data? And our answer is no, right? And we actually had to really beat down the VCs on this, because the VCs were like, no, go, expand to healthcare, expand. And we're like, no, because these are all extremely difficult domains with a lot of sort of deep proprietary knowledge in each of them, not just finance, healthcare, all these things. And so we just, in many respects, followed the mold of Mike Bloomberg. One of the things that he did very well is, there's no Bloomberg terminal for healthcare. There just isn't. And it's not because Mike never had the opportunity in the course of becoming a multi-billionaire to expand to healthcare. It's that he had a very old-fashioned way of thinking about a business, which is a brick and mortar style way of thinking about a business, build domain specific knowledge, really become the best in the world at operationally executing on that. And that's it. There's no and then. That's it. And if you happen to pick a very big industry like finance, you can build a $40 billion company. Or even if you're starting out, you can build a $1 billion company. And that's fine. There doesn't have to be a more to that. And so I think the VCs have gotten kind of smacked on the arm with a lot of the early companies they bought, and have adjusted in terms of the way they encourage newer companies.
So respect the domain.
Respect the domain.
Respect the domain.
And don't listen to VCs.
Okay.
Teach VCs. Teach VCs new models, because they know how to. They're like generals in the Second World War. They know how to fight the last war. They don't know how to.
Okay. As we adopt more innovative technologies, how do you see financial intermediaries evolving, and what's going to evolve first?
Yeah, as you can probably tell from my last comments, I'm skeptical of the view that the entire financial system gets disintermediated. I know that's the most fashionable thesis now among VCs, that whether through cryptocurrencies or through consumer-facing credit availability, that you just circumvent the banking system entirely. And I think that's maybe possible if your time horizon is 40 to 50 years. So it comes down to what time horizon are you talking about. The reality is most investors, and I think of both VCs and the entrepreneur as an investor in a business, neither of the investors, the entrepreneur nor the VC, are, if you ask them and they're honest about it, investing for a 40-year time horizon. They're investing for like a 5-year time horizon maximum. And on a 5-year time horizon, I just from where I stand and what I see, I don't see that as realistic. And the reason it's not realistic is called the US government. These are very deeply regulated spaces, and I think the risk of a business model that says we're going to disintermediate the banking system is, and I say this partially with my Fed hat on and what I was able to see in the Fed. If somebody comes in and says we're going to disintermediate the credit system, the banking system, until a certain point, nobody pays attention because they're too small. The reality is the moment they actually get successful on that thesis, the Fed comes in and says, wait a second, we just spent the last 120 years regulating that system, okay, and gaining control over it. So, you still exist in a country with laws, and just because you're in Silicon Valley doesn't mean we can't legislate you. And they're going to come in and regulate these companies, and then they're going to be forced to either fail or become the very system they're trying to disintermediate. So, I think for that to change, you really need a 40 to 50 year time horizon for that to be realistic. My guess is 98% of the retail-facing, consumer-facing credit companies and cryptocurrency companies will be forced into a situation of either failure or become the very institutions that they were trying to disintermediate. And that's not something I'm encouraging as a good thing, that's the case. That's just the way, from my perspective at the Fed, the federal government thinks about these businesses.
Switch gears a little bit. So you are one of the beta residents of our Sandbox, which has been great to have the support. Why did you participate, or what value did you see?
Yeah, certainly. So when we were, one of the other backers of the firm was David Yagan, which was the It's the private equity arm of Fidelity. And I think one of the difficult things early on, before you build a very big company, in working in financial technology is how expensive the data is and how hard to acquire all this desperate data is. And so it was very helpful for us, the FinTech Sandbox program, because what it allowed us to do is say, all right, we think we can extend risk analytics or whatever we're working on to this domain of data, to this type of asset price and so on. And without having to buy the $45,000 a year Thomson Reuters contract to run an experiment on it, we could run experiments on it as a function of participating in that program. So I have nothing but positive things to say about it, and especially given that the challenge if you're starting a fintech company is acquiring this very expensive data to do your actual analysis on. Constructs like that help support entrepreneurs by bridging that gap, I think are such a benefit to the innovation that arises in the fintech space.
Thanks. Now you're growing, correct?
Yes. Yes, we are.
Yeah. So you're looking for people.
Yes. Yeah. So it's crazy. The company is less than 2 years old, and it just grew very quickly. So we have to now simultaneously expand. We started in Harvard Square because that's where I was doing my program, and we have to simultaneously expand. We just opened the World Trade Center in New York City, opening Palo Alto on the West Coast, opening Connecticut, opening London, opening Hong Kong. So it's difficult. It's challenging, and that would be one of my sort of kind of points of reflection, which is you need to strike a very good balance between when you scale, and you're forced to scale very rapidly, between spending all of your time scaling, which is perfectly possible to do, and staying in touch with whatever your core product is. And that's been the biggest challenge for me personally as a CEO, which is how do I not neglect the scaling piece, but how do I also not just focus on the scaling piece and just become IBM or whatever without actually focusing on that core product. So. But if folks are looking for creative things to do afterwards, please send us an application.
Okay. Great.
Yeah.
Thank you. I'd like to turn it out for questions if people have questions.
I know I ask a lot of questions, so thanks for your patience. I had just a question from the recruiting side and what the firm philosophy is. Is it to hire people with finance knowledge and teach them data science, or is it more people with data science programming and then learn finance, or is it?
It's the latter, and so we did something very I think there are a couple of factors that contributed to the growth. One was what I mentioned with actually respecting the domain and the knowledge. The other was we took a very different approach to finance, which is that we recruited exclusively engineers in the company. So we didn't recruit people with financial backgrounds or financial knowledge, other than at the I brought on as my COO the former CIO of Credit Suisse and so on. So I brought on some executives from Wall Street at the senior level. But in terms of the non-executive level, we just hired engineers from really from 2 or 3 companies, from Google and Facebook predominantly. And that was a key piece of our strategy, which was that if folks, not only did we just hire engineers, we didn't hire anyone who was an engineer in the financial technology space. And our hypothesis was, if you had spent the last X years of your life being an engineer in that space, that you would be imprisoned in a lot of the constructs that come from focusing all your energy on any space. So that's been our strategy historically, to just hire, and that's been a very unique aspect of the culture, to just hire engineers from a purely kind of consumer technology background like Google and Facebook, and deploy them toward the space. The precedent for what we did, the only precedent I can think of, is what Palantir did in the defense and security space, where they also basically arbitraged engineers from Facebook predominantly at that point to the defense and security space, where those companies those buyers, the government, had historically been dealing with Lockheed Martin and firms like that were just much more legacy incumbent companies.
I was going to ask a follow-up.
Yep.
How do you bridge the domain knowledge of someone with an engineering background and understanding what the clients want this?
Yeah. So we bridged it by so maybe our third innovation was actually creating a consortium of the banking system around the company, so that they're not simply clients, but they're not simply arm's length clients. They're actually the largest shareholders outside of the employees in the company are the Goldman Sachses of the world, are the fill in the blank, the financial institutions of the world. And so we actually allowed their ownership structure in the company to drive product development, which was kind of our strategy. And it's a different strategy than us sitting in a room and saying, at arm's length from the banking system, what might the banking system want? We sort of said, well, let's create an ownership structure, let's create a consortium of the actual banking system around the firm so that they could drive product development. So we, very practically what that means is we have, weekly technology development meetings. They're called weekly technology co-development meetings at Goldman Sachs. So we have the senior traders actually driving the technology development. And to be frank, that costs us nothing, whereas to hire them would cost $10 million a year each. So it's cheaper to do it that way.
Other questions? Oh, down here.
It was great that you sort of mentioned the contrarian view that financial institutions like we know them are not going to go away in 10 years' time, disrupted completely. So on that point, if you were advising a large financial institution, right, take your pick from one across the river, how would you advise them to actually utilize all the modern technology that's now available, literally in the last 5 years? How should they sort of change themselves or think about utilizing some of these tools differently than they've done in the past?
Yeah, I do advise them to buy them. I think it's a false, as you could probably infer from my previous comments, it's a false dichotomy to think of most of these things as disintermediating the system, because if they get even 15% success, they will just become regulated. That's my view from my background at the Fed. We work with Bank of America, Merrill Lynch, we work with all of these big institutions, and when I talk to the CEO of Bank of America, and he says, well, what do you think about cryptocurrencies, or what do you think about retail-facing credit providers and so on? My answer is always like, you have to pick the right ones, and it's not as a but you should buy them. You should buy these companies, not their products. You should just buy the companies and incorporate them into your Bank of America mobile banking app and incorporate their security features into your security features. So this is just one opinion, so take it for what it's worth. I think that's the end game for these companies. I think the banks will look at each of these spaces, find the 2 or 3 most interesting ones, and simply buy them and incorporate and amalgamate their technologies into their core systems. I would bet a lot of money that if we were doing this talk 10 years from now, it's still going to be Bank of America, still going to be Goldman Sachs, they're still going to be what they are today. They're still going to be the largest financial institutions. They're still going to be the hegemonic providers of credit to the system. I don't think that's going to change. But there might have been a lot of entrepreneurs that had some very successful exits along the way to that. And I think that's where the opportunity is. But in terms of culturally, these banks have feelings too. And, I wouldn't say that the optimal strategy, I know the VCs want to clap and do this, and Peter Thiel gets up there and they go screw the banking system and disintermediate and so on. That's not the optimal strategy to get your company bought by them. I think just for what it's worth, I think if you go out there and say, hey, we're going to take down credit, or we're going to take down asset management, A, you're not. B, if you succeed halfway, you'll be regulated, so you'll have the same problem that they do, and you'll force to fold. And 3, more importantly, if you take that antagonistic view toward the system, they're going to buy your competitor as opposed to you. So take that for what it's worth.
Great. One more question.
I'd like to ask a follow-up question to this discussion about disruption, because a majority of me agrees with your comments, but I also hear a fair amount of comments just out in the marketplace about how that effect is actually regulatory capture by the large institutions,
yep,
as opposed to sort of a Darwinian state where evolving, but in fact regulatory captured state, and so these institutions are fixing it so there cannot be this disruption. Is that bunk, or is that true?
How many people in this room, by show of hands, have a lobbyist in Washington on their payroll on the Senate Financial Committee? All right. Well, all of our clients do. And that's my answer.
All right. Thank you very much.